Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Long Verticals and Diagonals. And today, I thought, you know what? Let's go through how to build a long call vertical spread on Thinkorswim, just step by step, a tutorial for taking a trade from concept all the way to execution and management. I think that's going to be a good topic to cover. I'm really looking forward to it. Before we can get to that, let me first of all say hello to everybody who's already chatting in out there on YouTube. I'm seeing a lot of familiar names, a couple that are new to me, but welcome to everybody. Hello there, Janelle and Ricebird, Andy, Vic, Sharon, Chris B, Josh, everybody else. Thanks for joining us week after week. I really do appreciate your attendance and your contributions to these discussions. If you are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, we'll enjoy the presentation, but be aware that you're invited to join us in the live discussion. This is a Thursday webcast series, kicks off promptly 11 Eastern time. We'd love to have you here in the live stream audience. And as a treat for my live stream audience members, my very good friend Brent Moores is going to be hanging out in the chats. Brent's going to be addressing any questions that I can't get to just during the flow of the presentation. Brent and I have been working together now for more than 20 years. And as long as I've been doing this, I think Brent outstrips me by like 5 years, something like that. It's a great resource to have there. Thanks for having my back there, Brent. Brent and I would also like to issue an invitation to everybody watching. If you have an account on X, you should be following your favorite presenters there. It's the best place to connect with us in between these live streams. I know I've been chatting with some of you just within the last 24, 48 hours through that platform. So you can follow Brent there at Brent Moores CS. You can follow me on X at Cameron May CS. But let's get into this discussion of how to build a long call vertical spread on the Thinkorswim platform. And as we do, of course, we need to consider the risks associated with trading and investing. Risks are real. We need to bear them in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so let's outline how we're going to go through the next 45 minutes together. I'm going to reverse the order of things. Typically, what I've done in the past is we take a quick look at our current positions, we make management decisions regarding those, then we look at the markets, and then we get to the topic of the day. I'm going to leave the positions for the end of the discussion because I want to get right into the meat of the topic as quickly as possible. So we're going to start things off by having a quick look at the S&P 500 just to see what's going on with the markets. That's going to set the stage for today's discussion. So we can dive right into building a long call vertical spread on Thinkorswim. So it'll be market review, then discussion, and we'll wrap it up with a review of those positions. So let's go right to the markets. Now, if you haven't used Thinkorswim Desktop before, this is trading software that can be downloaded from within your Schwab Online account. You just go to the Trade tab and look for the keyword Thinkorswim and click on that, and it'll just guide you through. But you'll just log in once you've downloaded the software, log in using your Schwab username and password. And this is where we find ourselves now. So here's the S&P 500. And this webcast series allows for bullish or bearish strategies, but we've been doing really essentially exclusively bullish strategies for some time now because the markets have been so persistently bullish. And I'm going to continue with that outlook. Let's put ourselves in the shoes of a trader who's maybe planning a vertical spread of some type. Is it going to be bullish or is it going to be bearish? Well, with as bullish as the markets have been, let's just say our trader's outlook for trades for the next several weeks at least, maybe they think that that's likely to continue. So we are going to tilt toward a bullish vertical spread strategy, which is going to be a long call vertical. So not a lot to see here, folks, for the S&P 500, just another record high. That's all. Yeah, we're fading a little bit from those intraday highs, but still up about 0.5% over yesterday's close. So let that be the backdrop for today's discussion. Let's just say that our trader thinks that we're more likely to go up than down over the next several weeks, and so they want to construct a trade around that. So among the whole slate of potential strategies that might be implemented by an option trader in bullish market conditions is a long call vertical spread, which is a it's a key week-to-week element in this series. Really, we have about 4 strategies at our disposal for this series. This is our bullish strategy. This is one of the bullish strategies, long call vertical spread. So step number 1 in deciding to do a long call vertical spread may be to take a quick peek at the markets and for the trader to conclude, do they think that the markets themselves are likely to be bullish during the time frame of this planned trade? If so, then we'll move on to step 2, which is planning the trade. So I'm going to bring up an example stock here, and we're going to use Visa for today's example trade. I want to quickly discuss in this step, how do we decide on which stocks to place long call verticals on and to build upon? Well, among many considerations, there are lots of potential considerations, but there tend to be some that kind of tilt toward universal. I can't always say every trader thinks about things exactly the same way, but price per share can certainly be a consideration. More expensive stocks tend to have higher risks and obligations in the form of those contracts that we're entering into. Like, for example, if we sell a contract, we're taking on a larger obligation, we might have to trade a higher price stock. Can be a more expensive obligation. In any case, so price per share can be a concern. Very low price per share, smaller rights and obligations, but there also just tend to be not as many options to choose from on those lower price stocks. So there are trade-offs there. Liquidity is another common concern. It's a common pre-qualifier for traders of options. When we have an illiquid stock, it tends to have illiquid options that can have all sorts of pricing issues. The spread between the bid and the ask price can get wider, makes it harder to get into and harder to get out of those trades profitably. And we already know there are a sufficient number of obstacles without having some that are just built into the trade. So price per share and liquidity, but also what's going on with the chart. Many options traders use charts to sort of set the course for the trade that they're planning. And what we're looking at here with Visa, just to put ourselves again in the shoes of a potential bullish options trader, is the trader might be looking for, first of all, a stock that's primarily been climbing over the last 12 months. Because if it can just continue that direction, maybe that might tilt the scales of probability a little bit in their favor if the stock continues going forward upward. So for some traders, they do have that preference for an upward trending stock, and you can see left to right, Visa's had a pretty good year. More recently, though, it has consolidated. And you can see there's been maybe a resistance up here around the 360 level, maybe support down here around 345. Our stock's been moving into a channel. But what some technical traders will do when a stock is channeling is to look to see, well, are we closer to the channel lows and starting to rise? Or are we closer to the channel highs and starting to fall? And let's just say with this trader, bullish overall outlook over the last 12 months, and most recently within this channel, it's come down to lows. Maybe they expect this to start to rise again. All of those things may be adding up to a technical setup for a bullish trade, such as a long call vertical spread. So that's a market backdrop and a chart backdrop for planning this trade. And what some of you probably already noted on this chart is we are also beyond the earnings announcement. We're right in the thick of earnings season. And so when we're going through a list of potential trade candidates, if a trader doesn't want to get in right before an earnings announcement, they may want to keep an eye out for these icons down at the bottom. If you're not seeing them, they can be added right up here under your chart settings. Just go to equities and make sure that this box for show corporate actions is checked. Okay. But now let's move on to the planning of this trade. So we're building upon the work that we've already done. Let's build the trade itself. And I'm going to go over here to the trade tab and build our long call vertical spread. If you're not familiar with a long call vertical spread, it consists of two call contracts. And the objective of the trade, it's going to add up to a net bullish position with a defined maximum theoretical reward and risk, and also definable probabilities of success and failure on the strategy. Now, it can be set up to be high reward, but low probability. it can be set up to be lower reward, but higher probability. Unfortunately, there's no way I can show you to have high reward and high probability. That would be the magical combination. There's sort of a trade-off that the traders might want to consider there. But let's tie our setup, the building of this strategy, to our technical expectations for the stock. Interesting. Chris B says V is in a 9-day TTM squeeze. I'm not going to go too far into what that is, but Chris is saying could be an interesting trade if it breaks to the upside. Yeah, I've covered the TTM squeeze in my Friday webcast series in the past. So guys, let me make a quick suggestion here to sort of dovetail on Chris's point here. If you have an interest in a topic or a strategy that's not being explicitly discussed or covered in the webcast you're currently watching, just make sure that you first of all subscribe to our YouTube channel. You can go down and click on the subscribe button down in the lower right-hand corner right now. It only takes a second to subscribe. It doesn't cost anything. But our Trader Talk Schwab Coaching webcast channel is where we house previous webcasts. You can go to playlists of entire series of webcasts right there. You can join the live streams, or you can even do searches for topics of interest. So for example, Chris is talking about the TTM squeeze. Let's just type in TTM. Do a quick search here, and you'll notice, hey, who's this guy's forehead? Right down there. Evaluating stock trend strength with the TTM. Actually, this is the wave indicator. A little bit further down. TTM squeeze. There we go. All right, but yeah, great resource. Make sure that you're subscribed. But let's go back to our strategy here, and let's outline our example trade. This is known as a long call vertical, a long call vertical spread. I'll just call a long call spread to save myself a little bit of typing. But conceptually, it starts with a bullish long call. We're going to buy a call. So if we tie that to our chart, let's say that our trader thinks that we've found support down here about 345, and we're likely to start to rise. So what if we were to buy, let's say, a 340 call? Go to the trade tab, see what that would cost us. Let's stay here with, well, here's another potential consideration. How far out might we want to place our trade? You know what? Let me address that first. So a little bit of backpedaling here. I hope you don't mind the quick stop and reverse. I think it's going to be valuable, though. These trades can be set up for, as I mentioned earlier, high reward potential, but lower probability of success, or high, let's say, lower reward potential, higher probability of success. I'm going to set one up that's more the latter. We're going to go for trade where we're not really trying to swing hard and hit a home run. We're trying to set up the trade to have a comparatively modest reward potential, but a higher probability of success. Now that just making that decision can tie into the expiration that the trader selects. Typically, higher reward trades require the stock to go somewhere, and it's going to need some time to get there. So in pursuit of that reward, we might need patience, or we might need to add some more time on our expiration. The higher probability trades, on the other hand, may not require the stock to go anywhere. And as a matter of fact, they don't. Stock can stay right where it is. Really what we need there is for time to pass quickly. So as a general rule of thumb, this is not universally true. Not everybody does it this way. But traders who are looking for higher reward, they may add a couple of days, a few weeks to the trade to give the stock some time to move. Traders who are looking for a more modest reward, a smaller reward with higher probability of success, they might try to have as few days as possible on the contract to give the stock less time to misbehave. So we're going to maybe set up our trade. Let's stick here with just August, the August 15th expiration. That's going to be 15 days away. All right. And as our example now, we're going to buy, let's say, the 340 call. All right. So buy the 15th of August, 340 call. That looks like that's trading. How much is that trading for? Between $12 and $12.30. We'll call it $12.15. So what we're doing here is we're spending some money, $12.15 per share on 100 shares. This is a standard contract, so it's 100 shares. So we're spending $1,215, setting commissions aside. But in exchange, we have the right to buy shares for $340. Well, those shares are already worth nearly $350. So we have some inherent or intrinsic value in that contract. What we're hoping is that intrinsic value increases, the stock goes up. Now that would just be a long call, and that is a bullish strategy. We could just go with that, but there are some disadvantages to that. That's actually an inherently low probability trade. So I'm going to flip-flop the probabilities on this scenario by doing this. We're going to turn this in from a long call into a long call spread. At the same time we buy that 340 call, we're going to sell, and let's say for this one, let's sell the 345 call. Sell the 15th of August, 345 call. And that looks like that might bring in between 825 and 855. Let's call it 840. So net, what we're doing here is we're spending $12.15, but receiving $840. So $12.15 minus $840 means that the net debit to our account is $3.75. Again, commissions are a consideration here. We'll talk about those as we place the order, but they're a relatively minor consideration. I'm leaving them out of this math just to keep the math simple for now. All right, but net debit here projected of $3.75. So what have we net accomplished with our 375? Well, because of the 12.15 we spent, we have the right to buy shares for 340. But because we took on an obligation as we sold or collected the 840, someone else has the right to buy those shares from us for 345. So if we buy shares for 340 and we sell those shares at 345, that'd be a $5 profit if this were a free trade. It's not a free trade. It cost us $3.75 to set that up. So what does that leave us as the theoretical maximum gain of this trade? Well, $5 profit minus $3.75 to set it up means that we have $1.25 that we can potentially risk. Andy says, seems expensive, more than 50% of the potential return. Andy, that's a good question. There are traders out there who set for themselves a minimum, let's say, return objective for every dollar that they're spending. What they're going to have to be prepared to settle for, though, is a maximum probability of success. With vertical spreads, they're extremely customizable. We can tailor it really to just suit exactly how a trader likes, or very closely to how a trader likes to pursue things. Yes, a trader can say, I want at least 50% reward potential for every dollar of risk that I'm taking. But that's going to be associated with a pretty specific probability. Here's the teeter-totter effect. If we want a higher potential reward, the probability of success in getting that reward goes down. It's going to do it. It's happened every time I've ever run these calculations on vertical spreads, and I've been doing this for a long time. I'm always tempted to say it always works this way, but always is too big of a word. I'll just say almost always, almost no exceptions, none that I've ever found. There's this teeter-totter effect. So if we want that higher probability, or that higher percentage return, the probability of success goes down. If we're willing to settle for a lower percentage return, the probability of success goes up. That's the way it works. So we can actually look at these in fairly explicit, specific terms. Now this net debit, this is our investment in this trade, and we'll see what it actually turns out to be as we place the trade, but for now, that's what we're projecting it to be. That's also equivalent to the theoretical maximum loss of this trade. And what you will see with a high probability trade with vertical spreads is that the reward, the potential for reward, is going to be lower than the potential risk. That's because the probability of success outstrips, or maybe greatly outstrips, the probability of failure. Melissa says it's always a trade-off. Yep. Here's the problem, Melissa. If somebody finds one exception ever to the word always, then I'm wrong. I don't like to say things that are not true. Every scenario I've ever run has always been in keeping with what I've said, but I have to provide for the potential scenario where somebody might find an exception. So I'll just say almost always. Okay. But in any case, yep. Why would anybody risk $3.75 in pursuit of $1.25? Actually, anybody that ever buys a fixed income security is taking a very large risk. Almost no probability of incurring that risk, but a very large risk in pursuit of a tiny little reward compared to the risk. And yet that's very routine. So what am I talking about? Fixed income security, I'm talking about bonds, that sort of a thing. But yeah, when there is a high probability of success on something, the associated reward tends to be smaller. The nice thing about vertical spreads is that it's highly customizable. I could set this up. I could reverse this scenario, set up a reward. And as a matter of fact, this is working out to be exactly 3 times, right? 3 times the risk in this trade as reward potential. Yep. I could reverse that just by choosing other strikes. I could go out of the money, lower probability calls out of the money, but if we happen to get it right, we can get a higher reward for that. So Janelle says, now you preface your comments with your friends as almost. Yeah, there you go. That's good. That's an accurate way to describe what we're setting up here. Anyway, so let's look at the probabilities here. I don't have to change a thing on my screen to see the probabilities of success or failure on this trade as we've currently constructed it. What are those probabilities? Let me throw this out there. What are the odds? Using what you're seeing on your screen right now, what are the odds that this trade works out just as we're planning? Who can tell me that? There is a 65% chance of maximum gain being achieved at expiration. And I'm seeing that using my delta. Delta has a couple of purposes for traders, including, like let's say there's our 345 call, and it has a delta of 65. That delta can tell us how much the option might change in value as the stock goes up or down $1, 65 cents up or down. But it also gives a rough estimate of the likelihood of expiring in the money. And with both of these contracts, we prefer that they expire in the money. There's a 65% probability that we do just that. Let's put that right here. 65%. Let me give myself a little bit more space here. Probability of maximum success. What's the probability of maximum failure? Theoretical maximum loss. Well, that would be if we're below 340, if both these contracts expire worthless. Well, there's a 76% chance that doesn't happen. When we look at delta, it's probability that these expire in the money. If they expire out of the money, we lose that investment. We'd have loss. So there's a 24% probability of maximum theoretical loss. So you can see why for some traders, they might look at this and say, well, just the math says I'm probably going to make the $1.25. There's a relatively small chance that I lose the 375. Plus, I've gone to all this trouble to look at the charts just to see if I can just tilt those scales of probability a little bit further. Now, just because we think we're at support doesn't mean the stock is definitely going up. But for some traders, that may be evidence that maybe we're more likely to rise than fall. And to help us visualize this trade as we're constructing it, let's see, this goes out through the 15th of August. That's right out through this expiration. Let's draw in some lines here. I'm going to draw one in at 345. These represent our trade. Okay, so there's our 345 strike. And then here's our 340 strike. It's going to be right down here. There we go. That's our little trade. That's our little spread down there. And really, as long as we're above that spread at expiration, this trade's in good position for its maximum theoretical gain. If we collapse down through that spread, that's where we're in position for our maximum loss. Right? So we've notice how that coincides with the trader's expectation from what they've seen on the chart. We've set up this strategy to sort of avoid, I don't know, a danger zone. If we think the stock is likely to go up or at least stay above this 345 level, well, that would be optimal for this trade. So let's analyze that. I don't commonly go into the Analyze tab, but I'm going to do that today because I do think it's a useful tool. Let's build our trade, though. How do we build this trade quickly? Here's one quick way to do it. I'm going to hold down the Control key on my keyboard, go to the call that I'm buying, and I'm going to click on the ask price. Let's click on that ask price. And that creates an order to buy. Let me just hide this left column for just a moment, just so we can see the full order that we're putting together here. So for me, this brings up an order to buy one contract, buying one of the 340 calls. But then I can go back up to the option chain. And while I'm holding down the Control key on my keyboard, I'm going to click on the bid price for the option that I intend to sell. And that creates that vertical spread. So there we go, buying the 340, selling the 345. It looks like maybe a 365 debit. Let's say that we're willing to spend the 375. We could just type it in. I'm kind of using the slide bar. We could have just typed it in right there. But let's do a quick calculation. If we were just buying one contract, one vertical spread, that would be a $375 risk. In this webcast series, we try to limit the risk to about $4,000. That would allow us to actually get about 10 vertical spreads. Because if the trade completely flopped and we lost the full investment, our maximum theoretical loss would be $3.75 times 1,000 shares. That would be $3,750. The maximum theoretical gain here would be $1.25 times 1,000 shares, or $1,250. All right. But before I submit this order, let me just make sure I'm not missing any questions here. I don't think I have, but that's how the trade may be placed. Just for the first timers who've never placed a vertical spread, when we have the strikes that are, let's say, several strikes apart, holding down that Control key is a nice little feature. We can just click on the ask price for options that we intend to buy, click on the bid price for the options that we intend to sell. But let's also see what we're getting ourselves into using that Analyze tool. So if you're not familiar with the Analyze tool, we can actually put together a risk-reward chart very quickly using a tool on Thinkorswim called the Analyze Risk Profile. I'm going to right-click on the order and select Analyze Trade. And that's going to take us right to our risk profile on the Analyze tab of Thinkorswim. And what I want to focus on is this red line. That red line is showing us it's the intersection of price with profit or loss. So we have profit or loss potential on the y-axis as a vertical axis over here. We have hypothetical stock prices on the x-axis down here. And you see right here is where the stock is right now. We're at 349.27. And we can just sort of ask ourselves, well, how does this trade work? How would it likely work out at expiration if the stock were to go up or if it were to go down? Down below, we can see here is the trade. So this is analyzing this trade. So if we're starting at 349.27 and the stock goes up, let's say it goes up to 350 or 360 or 370, and we intersect that with our profit or loss line, well, you can see, regardless of which level, if we're above the current price at expiration, we're actually up at the maximum gain. It's intersecting with about $1,250. Or if we look down in the lower left-hand corner, you can see the red number there is $1,250. I know that's two continents, one island. This asks a really good question. Any concerns about the risk of assignment? There can be, but I'm going to throw up risk. That's a great question. I'm going to put risk in air quotes because assignment is probably the objective of the trade that the trader is shooting for. Okay, so let me park your question for just a second. I just want to quickly go back through this profit loss line. Then I'm going to go back to your question. Okay, But yeah, this chart is very nifty. It just lets us see how the trade likely works out at expiration if we're at certain price levels. And we can just use whatever price level. But what you'll notice is right there, where we start to hit that maximum theoretical gain, seeing our 1250 displayed as our projected profit, it's right at our 345. So if we're at 345 or higher, that's where this trade works out best. If we come up short of 345, we're surrendering maximum theoretical gain, hitting a break-even point, and then below this level, 340, it's going to be 343.75 is the break-even point for this trade. Below that, at expiration, we're going to be at not maximum loss. We're going to be in loss scenarios until we get down to maximum loss, which is where? 340. So, yep. So some traders like to see this to help visualize the reward and risk scenarios for this trade. So Chris B, Chris B summarized the answer that I was going to provide in a rather verbose way, very succinctly. He says that assignment is maximum gain on this trade. So when we say assignment risk, I know that with options, it's easy to think of assignment as a bad thing. Ooh, we don't want to be assigned. Actually, there are some trades where the trader wants exactly that. Let's talk this through. What does assignment mean? Well, we sold a 345 call, which means that someone else at any time between now and the 15th of August, they have the right to buy shares from us for $345. Well, at any moment, if they decide to assign that right, let's say they decide, okay, Cameron, I don't care what the stock is worth right now. I'm just going to buy the shares from you for $345. Well, at that moment, that trader says, that's fine, because I can buy the shares for $340. You buy them from me for $345, I buy them from somebody else for $340. That's a $5 realized gain minus the cost to set this trade up. That would be maximum theoretical gain right then. What early assignment means with this kind of a trade is it didn't take as long as we thought to make the maximum gain. So, but thanks for asking the question. That's a legit question, but it allowed me to make an important point here. So what we do not want to have happen is for the contracts to not be assigned. What if these contracts just expire worthless? Well, if the stock is down below 340, we're up here as we look at our trade tab again, stock's up at about 350. If it were to fall down below 340, if it's at 335, for example, and we get to expiration, someone else has the right to buy the shares from us for 345, they'd be overpaying by $10. They're probably not going to do that. So they walk away and we keep their 840. But if the shares only worth 335, our contract to buy at 340, we'd also be overpaying, and that's worthless. So in that case, we blew 1215, we kept 840. That's our maximum theoretical loss. Always says, could we include 75% of maximum gain for this trade? That's a great question. Let's talk about trade management. Now that we have built the trade, now that we understand the reward and risk profile of the trade, what about managing the trade? And what Hovis has proposed here is, well, even if we get, maybe we don't make $1.25, but if we could make 75% of that, that's most of the maximum gain. How could we do that? Well, and by the way, Hovis, yes, some traders do prefer to do things this way. Let's say, okay, let's go with 75%. What's 75% of $1.25? $1.25 times 0.75 means that if we could close this thing out, I'm going to round that off to, it's about 94 cents. Let's call it 95 cents. Okay, that's going to be a little bit more than 75%. But if instead of making a $1.25, if we could make 95 cents, we've made most of the profit. And if we can get out earlier than expiration, maybe a trader is satisfied with that. Well, how do we make 95 cents on a 375 investment? Here's what we do. Take 375 plus 95 cents means 470. If we could sell out of this vertical spread for 470, we'd be we're darn close to $5. We're just coming up a little bit short. And so let's put in order. Let's say our profit plan is close at 470 if possible. Now that's if the trade goes well. What if the trade doesn't go well? What if we've invested 375 in what we thought was going to be a bullish stock, and then it starts to go down and it's breaking through support and it's just looking like we're not going to get a sign of things? By the way, it just continues to cooperate. The price is going up. We're probably going to have to pay more for this trade anyway. But if it were to reverse and start going down, maybe the trader at some point just says, forget it. Let's just stop the bleeding and we're done. Well, in that case, maybe the trader just says, let's get out if this thing has fallen by, let's say, half. Not everybody draws a line at half. Some traders just hang on and try to give this opportunity to recover. Others may try to stop the bleeding even sooner. But let's say that our risk plan is to close at half. Well, what's half of 375? We might wind up having to pay 380 for this thing or something around there. Half is going to be around what, like $1.90? So how do we put these two plans into action as closely as we can? Here's how we might do that. So this is an order now to enter the trade. Let's change this from just a single order, which would just be to get in. Let's give ourselves the opportunity to get out. So I'm going to change this from a single order to a first triggers OCO. If the first order fills, it's going to trigger two exit orders to come into play. One to manage profits if they occur, one to help manage the risk if that tends to play out. So now I'm just going to come up to the original trade. I'm going to right click on it and create two opposite orders. Right click once and create an opposite order. Right click again, create an opposite order. So first of all, this first order, let's call this our optimistic order. Let's say that this is the one where we're going to try to exit for 470. And we're going to set that as a limit order, good till canceled. The other one is to exit if we drop down to 190. That's going to be our stop the bleeding. That's our stop order. Right? And we're going to make that good till canceled. So this now becomes a plan to manage profits if they happen, losses if they occur. All right, let me just make sure I'm not missing anything else. Nope, I'm not seeing any other questions that are coming in. Just be aware as we use a stop order, that's not a guarantee that if the value of our vertical is dropping, that we will get out for exactly 190. If it's falling quickly, it might be less. We have to be aware. AJ says, why 470? AJ, I only went with 470 because the question that was asked earlier was specifically, could we include a 75% of maximum gain exit? So it just came from an audience member asking that question. And I said, yeah, we can do that. And so we calculated, if we bought this for 375 with a maximum reward of $1.25, what's 75% of $1.25? And where would we sell to capture that 75% of our maximum theoretical gain? That's where that came from. But some traders may go with a different percentage. Some may say, I'm not going to get out early at all. I'm in this to try to make the full $1.25. Others might say, you know what, if I can get half of it, I'm satisfied with that. What I want to just show today, since this discussion is just how to build these trades on Thinkorswim, I want to say once we've conceptualized our exit, how do we put that plan into practice? Yeah. And he says, audience member, you mean student? Well, yeah, I suppose you can call me a teacher and people watching are the student. But we're all adults here. And it's just a personal thing. You'll notice I never refer to these as classes. I call them webcasts or videos. It's because school stresses me out, and I don't want to impose that stress on somebody else. We're having fun here, right? Anyway, there we go. We put our trade into practice. Let's do the fun part. This is a paper money trade, so there's no risk here. We're just learning. Anyways, I'm gonna click on confirm and send, and let's go back through our trade. We're going to buy 10 of these Visa verticals, buying the 340, selling a 345 call, trying to not spend more than 375. We'll see if we're able to get this. With the stock, I don't know, it's backed off a little bit. It's back down to 349s. Anyway, trying to buy this vertical for 375. If we're able to get that filled, then we have an order to get us out at 75% of our maximum gain at 470, or to get us out at 50% of our maximum loss at 190. Now, this stop is not a guarantee that we're going to sell for exactly 190. And due to potentially wide markets or liquidity risks at the time of activation, if the stop gets triggered, that order may be manually substituted with a limit order and then, upon activation, and it worked until it's filled. So that's referring to the stop order. Now, there are commissions to be paid getting into this trade and getting out of it. 10 contracts, we have to pay commissions on both sides. So $13 in, $13 out. Let's send this order off. And let's see if we can get it filled. I'm going to go to the working orders and see where, okay, we're offering a 375 debit. It's trading around 377. I don't know if that's going to fill. Let's give it a second here. We may have to do this. Right click, cancel, replace that order. I'm going to wait. Let's see if we can get that for 375. But guys, we've actually accomplished what I set out to do today. We've talked through, set the stage, which was just with a review of the markets. We've walked through how to build, analyze, and place and manage a vertical spread, a long call vertical spread on Thinkorswim platform. We didn't get a chance. That's okay to follow up on previous trades. We do that generally every week. We'll do that next week. All right. I think there was only really one that I was going to do anything to today. That was our misbehaving UNH diagonal spread. I was going to sell a call against that as an example. We'll do it next week. All right. But everybody, thanks for giving me your time today. Lots of education still to come in the rest of our webcasts throughout the day. Go enjoy those. I will plan on seeing you tomorrow for my discussion of advanced charting techniques. But between now and then, a couple of reminders of additional resources that you have outside of the live stream webcast. First of all, make sure that you've subscribed to our Trader Talks channel on YouTube. You can subscribe by clicking on the subscribe button down the lower right-hand corner. Literally only takes a second, doesn't cost anything. But the Trader Talks channel is where we house our playlists of our YouTube video series webcasts. Once we've concluded a webcast, it's added to the playlist with very few exceptions. You can also join our live streams right now, or as you saw demonstrated earlier, you can even do a keyword search for items of specific interest. Also, if you have an account on X, you should be following your favorite presenters there. You can find Brent there at Brent Moore CS. You can find me on X at Cameron May CS. Really, really is the very best place to connect with me in between these live streams. So there's my handle. This is the guy you're looking for. Darker beard at the time the picture was taken. But this is where I can post things like I threw out a quick reminder of the FOMC announcement yesterday, and I asked my followers what they were expecting to hear from that announcement. Did it align with what they actually heard? That'd be interesting to revisit. But when you reply to one of my posts, I get on there and I reply right back to you. So typically 10, 15, 20 people a day I'm just chatting back and forth with. So best place to connect with me. Also, thank you to everybody that's already clicked the thumbs up button. I can see about 150 people watching, and 64 have already clicked that YouTube like button. That's always appreciated. It's not just a pat on the back to your presenter, which it certainly is, and we appreciate it, but it also gives your presenter's webcast as a video a boost in the YouTube algorithm and helps more people find that webcast, so they can learn stuff like how to build a long call vertical spread on Thinkorswim. Laura, thank you. Anita, Jeannie, Frank, beauty at its best. Definitely my pleasure. Sounds like our order just filled. I heard it go bling in the background. Yep. So we are now sitting down here under our unallocated There's our Visa position. Let's right click. Let's move that to our long verticals and diagonals group there. Now it's in place. All right, everybody, go have a great day. I will look for you in a future webcast. I don't see a survey. Brent, thanks for keeping an eye on things for me out there in the chats, but I'll also look for our next guys. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.